Now, let's try to understand this word growth and how it plays a role in terms of profitability and in terms of economics. First thing, I would like to understand how these two important words are related, growth and profitability. First thing, we all will appreciate the fact when the firm is small, right? Probably I may get very much abnormal profits. But as the size of the firm keeps growing, the firm grows higher and higher, the profits wise, in terms of percentage, they get more and more stabled out. I can't have the same level of growth rate in the profits each year because at some point in time we will encounter the managerial diseconomies of scale. As my firm right now is 200 employee firm, let's say if it goes to 500, fair enough, I have managers who can handle. But probably if it goes to 5,000 in the next 1 year, I may not generate the same level of profitability because there is very much a possibility that I may not get the same level of experts who can manage 5,000 employee team where I was successful managing 500 employee team. Which means if the costs are going up drastically, right, and wherever I am looking at the average cost is going up, especially if the output that I am producing, see it's worth, with the current team, I am very much comfortable producing 1000 units. But in case my target is 1500 units, which means probably the target is much higher. In that case, I see that I end up with higher average costs because the managerial diseconomies of scale is going to come up. And at the same time, we know that the demand curve is sloping downwards, which means I can't sell. If my target was 1000 units, probably I could have sold quite comfortably. But if I have to produce 1500 units and sell 1500 units, probably I may have to eat the market share of my competitor. And that may result in a reduction in the price. And I may not get the economies of scale. So which means my costs are up, my prices are down, overall the profits are going down and in some cases negative. So that's where we really need to understand how these two words, the growth and the profitability, are linked. Because when I'm generating some profit, right? Okay, I have sold 1000 units. My revenue was 10,000. My expenses were 3,000 for that. And I have generated a profit of 7,000. Fine. But this 7,000, if I really have to grow, probably I have to plow it back as additional capital into the business. Otherwise, if I am taking this profit, if I am enjoying this profit, by withdrawing it, my growth is getting hampered. Where will I fund the growth from? The growth that is funded purely out of the profits will result more and more in a sustainable kind of a growth, but growth that is funded typically by external funding mechanisms like raising a debt or raising new equity capital is always expensive. So one side is whatever the profitability, it may affect, it is playing an important role in the growth. Profits are needed to finance the investment that is really required for the growth. And the more and more I am growing, I will not be able to withdraw in the short run. Right? So my profitability is getting affected in the sense I will not be able to enjoy the profit. The more and more I am targeting for a growth, the more and more retention of the profits I have to do for the investment of the capital, which means in the short run, my profitability is badly affected. Whereas in the long run, probably yes, all these which I have invested, it starts yielding fruit, which will result in higher profits in the long run, because that entire capital I can use for expansion purposes. I can produce more and more products, increase the economies of scale. So we have to really look at these two words: higher the profitability in a particular year. I really need to see whether this profitability or profit that the company has generated, is it paying out in the form of dividend, or is it retaining, which is contributing to the growth of the firm. So whenever we are talking about any market that is growing, we are very comfortably seeing that in that particular market, every firm will look like more profitable. Every firm is like growing. But the moment we see that in a particular market the growth is getting hampered, the only way the firm can survive in that particular market is either expand to the new product or get into the new product base, new markets, new products. Otherwise, it has to get exited out of the business. And here, one important point in this context: see, generally, when the share price of a company falls, it generally goes as a takeover target. And how will the share price of a company fall? Especially when the shareholders lose confidence in whatever the activity the company is doing, when they really are not comfortable on the activity of the company. Look at this scenario. Okay, there is a profit this company has generated. So using that profit, I expect that that profit amount is invested in some kind of new investment which will generate profits in the long run. Now, if it is putting the money in a new investment, obviously the payout is going down, because let's say out of the 7,000 profit the company has generated, let's say the management decides that it will pay 1,000 in the form of dividend to the shareholders, and the remaining 6,000 will be retained, which will contribute to the growth of the company. So if at all the company looks at retaining a significant portion of the profit, obviously the dividend which it is paying to the investors will come down. And if the dividend is coming down, if the shareholder really feels that 6,000, whatever it has retained, it's not worth growing at that extent. The company does not have the potential to grow. It has retained the money, but there are no avenues and opportunities for the company to grow. If that is the case, they lose the confidence, which will result in their selling off their shares, which will result in the share price falling. And more the share price falls, the stock becomes much cheaper. So some company which really feels, yes, at this price, this is a very cheap one, because there is a profit the company has generated, they have retained, but the company's management don't have the potential to create market opportunities for the growth. So let's buy out. So the takeovers become more and more comfortable in that particular scenario. And in another case, okay, now every company is fearing of a takeover, because if the shareholder loses confidence, look at this cycle. Shareholder loses confidence, lots and lots of selling of the shares will happen. The more the shares are sold, the stock price falls, and the stock price falling is resulting into a takeover target. Now every company's management is having that kind of a fear. So because of that, what they do, they will not generally take up the long-term projects. They are always focused towards short-term profit generation mechanisms. Right? Short-term profit generation will be the major objective, because the moment they are thinking long-term and trying to retain a lot of their profits without really paying any dividend, some shareholders may not be interested to that idea, and if more and more shareholders are not buying that particular idea, it may very well result in the price falling down. So the takeover constraint, the takeover fear which many firms have, it will really stop them from taking up more and more profitable long-term projects because they are more focused towards the short term itself. And that is on one side of the story. There is a shareholders fear, and because of that, the company's management need to be cautious of. Now let's try to listen to the other side of the story. Okay, company is not investing. Okay, on the other side, right now the story which we have heard is the company is investing heavily, not paying dividends. So some section of the shareholders will be disappointed and they will be selling their shares, which will result in a stock price fall, which will make it more and more like a takeover target. Now, my other side of the story is, let's say the firm is not investing. So if it is not investing, a huge portion of the profit is paid in the form of dividend. Now, if huge portion is paid in the form of a dividend, there could be some section of investors who would be feeling, why is the company paying so much? Doesn't have the potential to really grow? Doesn't is the management not able to identify the opportunities which can help it grow? Even that could result in some set of shareholders selling off their shares, which means even in that case the firm would be a target for takeover, because in that case the firms would be interested in buying that firm, because why should I distribute so much of dividend compared to the competitor? Why not I identify the opportunities for growth and invest accordingly? So this is where the assessment comes in terms of probably the comparisons come using this valuation ratio, where I'm looking at price to the book value of the share. So price is nothing but the market value per share and book value per share. Or probably if I take per share out, the numerator is nothing but market capitalization of the firm divided by the book value of the entire equity. So all these are one and the same definition. So it is looking at the stock market's assessment of the firm. How many times the book value of the equity is the market value? By how many times is the market price higher compared to the book value of the company? If it is much lower, it means that the book value is very high, the market capitalization is much lower, means the market price is much lesser, and this is what will go as from a takeover's perspective. These will become very good takeover targets because the book value of the equity is much higher, but the market's perception of the performance of the firm is much weaker, which means shareholders are not that confident about the firm, and those firms which are having a very low price to book value ratios, they become the major targets towards a takeover. They become the potential targets for takeover. And whenever you look at different ways in which any firm can grow, obviously the most cheapest or most economical kind of a mechanism is using the profits, retaining the profits, where there is no other external funding mechanism that is coming up, purely the funds coming internal. But what we generally see is when the markets are not doing well, the profits are falling. When the profits are falling, the growth opportunity, the retention part also will go down. When the retention part is going down, the typical growth opportunities for the future actually will go down. So that is one scenario, and especially when the markets are up, I see a different opposite situation coming up. So one is the internal source, the other one is an external source of funding through equity itself. Even the internal funds, the retained profits is also an equity mode of funding itself. So even the new share issues is an equity mode of funding. But even in this case, when the market is doing good, when there is a boom in the market, lots and lots of new capital will come up. But when the economy is in generally in a lower phase, in case of recessions, when the economy is in a recession and probably some kind of negative opinions start coming about the company, in this case we see that the confidence in the stock markets actually go down. So in that case, even the new share issues in the form of initial public offerings will traditionally go down. And on the other side, another source of funding that we can see is through the loans, right? Either bank based loans or they can issue bonds, which are more like fixed income instruments, which are another source of funding. Again, in this case also, especially the availability of credit, right? In if the economy is doing good, people are ready to give credit, to give loans. But again, when the economy is drying up, the recessionary phase of the economy, no one wants to lend. So again, the borrowing based capital also will go down during that period. And apart from in general economic availability of the credit, individual credit worthiness also will play an important role. To what extent each individual company is really worth, what is the kind of paying back potential that is associated with each individual firm. All these things need to be taken into consideration, which means not every time the growth can be funded effectively. Even though there is a profitable year, it purely depends on one, the general industry characteristics and economy characteristics, and two, more and more specific details associated with the firm. And apart from that, we also see there are various other constraints that really play an important role in the growth, especially when the firm is in the process of managerial expansion. Lots and lots of new top management come into picture, newly recruited team, whether it is top management or any other senior management layers, right? More and more new team being recruited for whatever reasons. They take huge amount of time for settling down, making the whole system run in their cohesive manner. So in that case, obviously we see that there is a constraint on the growth that can come up, and depends on how much experience the and the expertise the management team really has with respect to growing of the business. See, running a business smoothly is different from growing the business. A lot of aggressive decisions, calculated risk based decisions really need to be taken. And apart from that, what are the government policies? Because today one of the major sources of quicker expansion is relying on mergers and acquisition. So to what extent the government policies are influencing the mergers and acquisitions? What are the various constraints imposed by the government with respect to mergers and acquisitions? All these things collectively play an important role and act as different kinds of constraints as far as the growth of the company is concerned. So that is what is an initial understanding that we really need to have regarding the growth, and based on that we can really look at the different kinds of growth strategies. All right.